Okay, folks. As you know, your quizzes are upstairs, still waiting to be picked up, right? So pick them up as soon as you can, because as I said, there might be mistakes I made in the grading. The best way to bring them to my attention, I've thought about this. A Zoom office hour doesn't work for that because you have to show me your quiz and you don't want to do it in front of other people. Best thing to do is take a picture of the page where you think I've messed up and send me that picture and saying, you took off 2 points, but it looks like I should have lost only a point, and I will add the point back. On the quiz itself, as you know, I screwed up on problem 3. I graded the entire MBA valuation class before I realized I'd missed the word convertible in problem 3, and without that word, the problem becomes meaningless. And so I had to take ownership of that and gave 2 points for everybody on that problem. The good news then is none of you could have got less than a 2 on the quiz, because you got 2 no matter what. And most of you did well. I mean, there were little things here and there. A couple of things just for the next quiz. 2/3 of you did not write your name on the back of the quiz. I have it on, it's recorded, so I can go back and look at the recording. I think I mentioned it multiple times. I mentioned this to my wife, who teaches 2nd grade. She had some suggestions. I'm not going to put her suggestions into place yet, but if this happens again on the next quiz, because as you can see, picking up the quizzes becomes a nightmare if you don't have your name on the back. And finally, there were 2 of you who wrote just your first name. Come on, unless you're Kanye or LeBron or Zendaya, where everybody knows who you are. I don't know who you are. If you say, whatever, I won't mention the name because you know who the 2 of you are, And eventually you found out that you didn't, because you went to pick up the quiz and I couldn't find my quiz. The reason is if you don't have a last name, I have no idea who you are. I don't even know where to put you in the alphabetical order. So for God's sakes, write your name on the quiz. This is like an algebra problem. You have 1 equation. The most you can have is 1 unknown. With 350 people, if more than... Sorry? Go up and speak. I don't carry the quizzes around with me. So basically, make sure you pick up your quizzes. If there's a problem, just bring it to my attention and I'll fix it. Okay. So let's continue with where we left off. One final thing. Next week is spring break. That's good news. The bad news is, right? If spring break is here, we're halfway through the semester, which means a whole host of crap is coming at you right after. The middle of every semester is where everything hits the fan. And if I gave you that one-time deal of giving you feedback on your DCF, that one-time deal requires that you turn in your DCF to me by the end of this month, which sounds like a long time away, but that's 1 week after you come back from spring break. So I know you don't want to work on your DCF on your spring break, on whatever beach you plan to hang out on. So at least get the process started before you leave for spring break. Try to do something this week. Even if it's nothing else, and entering the numbers in the spreadsheet and getting that first run going, getting started is actually the most difficult part of this process. So get the process going, start at least thinking about the valuation. And when you come back from spring break, you have a week to kind of get your DCF in, and I'll give you my feedback. So today we're going to talk about the elephant in the room. In discounted cash flow valuation, the biggest number is always your terminal value. And it's where damage, real damage gets done in most DCFs in the terminal value. So today's start of the class test, I'm going to focus on some issues relating to terminal value. And today, obviously, we'll spend more time on this. So when you think about estimating terminal value, it's that number in year 5 or year 10 that you estimate your company is going to be worth. I'm going to list 4 different ways of estimating terminal value. And I'm going to tell you upfront that one of these approaches should never, ever, 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 ever be used. I'm pretty categorical on this one. And I want you to tell me which of these approaches is not an approach you can use to get terminal value. So here are the choices. Liquidation value, where basically you get to year 10, you liquidate the assets, you get the liquidation value. The second is a stable growth model. You get to year 10, you assume a growth rate in perpetuity. The third is what's called a growing annuity. You get to year 10, but instead of assuming cash flows continue forever, which is what a stable growth model assumes, you assume they'll continue for another 15 or 20 years, but then they end. And finally, you can get a terminal value by using what's called an exit multiple. You know what an exit multiple is? You take your EBITDA in year 10, you multiply by 6 or 8, you get a terminal value. You get your revenues in year 10, multiply by 2.5, which is the revenue multiple, you get a terminal value. So which of these 4 should never, ever, ever be used in a DCF as your terminal value? And why? Right? An exit multiple, which is extraordinarily bad news if any of you worked in banking, because in banking, 80% of DCFs, the terminal value comes from using an exit multiple. I call these kabuki DCFs. You know, you've seen a kabuki dance, very elaborate. It looks like it's going somewhere, but the whole thing is planned. Kabuki DCFs, while I'm distracted by your cash flows, what do? You slip in 8 times EBITDA into your terminal year, and that becomes your biggest number driving your valuation. Remember the contrast we drew between valuing something and pricing something? I said there's nothing wrong with pricing, but if you make your terminal value a multiple, you're basically pricing your company. You've lost the intrinsic value component in a DCF. So no exit multiples, but the other 3 are okay. We'll talk about when you might use one over the other today. Here's the second question. Let's say you're valuing a company, you get to year 10. This company is expected to have after-tax operating income of $100 million in perpetuity with no growth. Company's cost of capital is 10%. What's the terminal value for this company? I've given you a bunch of clues here, which implicitly should make this valuation very simple. Anybody want to try what the terminal value should be for this company? You want to try? What should the terminal value be? Looks like I'm missing some information, right? What does it look like I'm not giving you? I've given you after-tax operating income, but usually to get to free cash flow, you need net capex and change in working capital. And I don't seem to be giving you that, but I've given you something else. I've told you the growth rate is 0. When you have a 0 growth rate, how much do you need to reinvest? 0. You don't need to reinvest money because you're not growing, which means your after-tax operating income is going to become your free cash flow to the firm. So let's make this simple. You got $100 million in cash flows every year forever. You got a 10% cost of capital. You don't need a calculator for this one, right? What's your terminal value going to be? $1 billion, 100 million divided by 0.1. Now, let me ask you a question. And for this one, I'm not going to ask for an answer right now, because after today's class, I want you to revisit whatever answer you get. So in this case, I have no growth, right? What's the conventional wisdom in terminal value? If you increase the growth rate, the terminal value will go up. So here's what I want you to think about. Let's assume that I take the same company and I give it a 2% growth rate forever. As I said, I'm not going to ask you to think for the answer right now. I want you to think about what you think, what your priors tell you what the answer should be. Which of the following will happen to the terminal value? The terminal value will go up. So if that's your answer, circle it for the moment. Don't tell me. It will go down. So circle that if that's okay. It will not change. None of the above, which is actually not an answer that you really make sense, because it's, it's got to be one of the 3. Hopefully you won't pick D. I just threw it in there just to see. Or any of the above. Made your choice? Because later at the end of today's class, I'm going to ask you to revisit this question. Because again, I want you to think about the conventional wisdom. Increase the growth rate, terminal value always goes up. We're going to see today that that is not true and why it's not true. And what is it that drives the relationship between growth and terminal value? It's a lot on our plate, so let's get the process rolling. So last session, we were talking about ways in which a company can pump up its return on equity, right? It can either take great projects or use average projects and use a lot of debt. But in that traditional approach, the first approach, you took the retention ratio times return on equity and said the growth rate in earnings per share is the product of those two numbers. Today, I want to expand on that notion. Let's assume instead of looking at earnings per share, you're looking at net income, and not just all net income, but net income just from operating assets. You can also make income from cash and marketable securities. Let's keep them out. They're a distraction. Let's focus on growth in non-cash net income. Let's think about how we define how much you reinvest and how well you reinvest if that's what you're trying to estimate growth. First, let's visit how much you reinvest. Rather than look at the retention ratio, where I assume that everything you don't pay out in dividends gets reinvested back, which is not true, right? You can hold it as cash. I'm going to actually estimate how much you put into reinvestment. By doing what? Remember, net capex and change in working capital is what you're putting back into the business. I can measure that. I'm going to look at it. And because I'm looking at just equity, remember, some of that reinvestment could come from debt. I'm going to net out how much of that comes from debt. So if I have $1 billion in reinvestment and $250 million comes from debt, I have to come up with only $750 million. So rather than assume that everything you retain is reinvested, I'm actually measuring what you reinvest and how much of it comes from equity. If I divide that by the net income I'm getting from my operating assets, which is whatever net income I get if I subtract out the interest income from cash, I get a non-cash return on equity. So already you can see a subtle difference. The retention ratio, I'm going to look at what's called the equity reinvestment rate, the percentage of whatever of my net income that goes back into the business. So looking at total return on equity, I look at only the return on equity on my non-cash assets. It's abstract, right? Let's write an example. You're all familiar with CocaCola. How does CocaCola make money? Ultimately, it's selling soda. But what makes Coca-Cola very different from Pepsi and the other beverage companies is about 40 years ago, Coca-Cola took its bottling operations, which does the grunt work of making the beverage, and it spun it off as a separate company. I know many people who bought the wrong Coca-Cola because there are two listed Coca-Cola companies. One owns a bottling business. The other is the company that just sells the syrup. Which is the one that you'd rather have? Buy the beverage, the syrup, right? Because the bottling company, first, it's a commodity business. Second, it's completely at the mercy of Coca-Cola because it's got only one customer, which is Coca-Cola. So Coca-Cola has been one of the most, if you go back the last 30 or 40 years, one of the most successful stocks in the US equity market. Berkshire Hathaway took a large position in Coca-Cola 35 years ago, and they've made a ton of money on it. So I wanted to estimate the growth rate in non-cash net income at Coca-Cola using what I just described. So let's go through the numbers. In 2010, Coca-Cola had net income of $11.8 billion. That syrup is incredibly lucrative. The total book value of equity is $25 billion. In your head, do the return equity. Even a traditional ROE, you take 11 billion divided by 25 billion, that gives them a return equity like 40%. And this has no debt. Basically, they have very little debt. It's coming entirely from the profitability of the business. They had a cash balance of 7 billion, and they earned income of $105 million on that cash balance. Why is it so low? It's cash. It's marketable securities. T-bills are making 1.5% to 2%. So I'm not surprised the net income is only 105 million. They also had a capex of 2.2 billion and depreciation of 1.4 billion. So the net capex was about 700 million, and their working capital went up by 335 million. And during the course of the year, their debt increased by about 150 million. You're saying, why are you giving us all these random facts? Let's start working through how much Coca-Cola's reinvestment rate was from an equity. I'm sorry. Somebody on Zoom had a question? Let's look at what the reinvestment rate and the return equity are from an equity investor's perspective. So let's start with the reinvestment. 2.2 billion minus 1.4 billion, that's a net capex. Change in working capital, 335 million. You add those numbers up, that's a total reinvestment. 150 million of that came from debt. So the equity investors reinvested only $957 million. That's the equity reinvestment. Their net income was 11.8 billion, but 105 million of that came from cash. If I take out that 105 million, their net income from non-cash assets was about 11.7 billion. You divide the 957 by the 11.7 billion, you get a reinvestment rate of 8.18%. Doesn't look like Coca-Cola was reinvesting very much. We'll come back and ask why the reinvestment rate might be so low, but it's a low reinvestment rate. Now, normally when you have a low reinvestment rate, what kind of growth rate do you have? You have a low growth rate. The saving grace for Coca-Cola is because their book equity, if you take out the effect of cash, is 18.3 billion, the return on equity is sky high. They have a low reinvestment rate and a sky high return on equity. The end result is not a great growth rate, but a reasonable growth rate. The growth rate is going to be about 5% plus, like 5.22% if you take the equity reinvestment rate times the return non-cash ROE. I really think I may be skewing the numbers here because of something I did not do at Coca-Cola that I probably should have done. And I'll give you a clue. Remember we talked about R&D? We talked about other companies that have R&D-like expenditures that we should be capitalizing. In the case of Coca-Cola, what should I be capitalizing, you think, to bring into CapEx?
Can I guess?
Advertising, basically, for building up their brand name, right? That's their biggest asset. What else do they have? The syrup is kind of meaningless, the brand name. If I capitalize R&D, I want to ask you a question about what's going to happen to my numbers. If I capitalize advertising here, what's going to happen to my equity reinvestment rate? So by capitalizing it, I'm going to treat what they spend on advertising like CapEx, my reinvestment rate is going to go up. That's good news. What's going to happen to my non-cash ROE? When I capitalize something, I bring it into book equity. My book equity is going to increase. My non-cash ROE is going to go down. I'm not saying the growth will not change, but I'll get a very different perspective on growth if I capitalize brand. This is why we capitalize R&D. We capitalize brand names. We capitalize customer acquisition costs, because then we get a better sense of what the company is actually reinvesting and how well it's reinvesting. So that's our second stop. We've gone from earnings per share to non-cash net income. Let's make the third stop. Let's say I want to estimate growth in operating income. Now, when I ask you how much are you reinvesting and how well are you reinvesting, your answers are going to be entirely different. And here's why. When you measure reinvestment from a firm perspective, you're going to look at net capex and change in working capital. But this is so you're not going to net out debt because this is total reinvestment. And instead of dividing by net income, you're dividing by after-tax operating income. Again, if you get a chance, put all three equations next to each other: retention ratio, equity reinvestment rate, total reinvestment rate. You're going to see I'm trying to do the same thing from different perspectives. And when you ask me how well am I reinvesting, I'm going to measure that with a return on capital or a return on invested capital. They're both interchangeable words at least in my lexicon. So I take the after-tax operating income divided by not just book equity, but book value of equity plus debt minus cash. Reinvestment rate times return on capital is my expected growth rate in operating income. Again, what I said about efficiency still applies. If you're a company that earns a higher return on capital, I benefit in one of two ways. I either get a higher growth rate if you reinvest like every other company, or I get much more cash flows returned to me if you reinvest less than other companies and deliver the same growth rate. Other things remaining equal, you want companies with high returns on capital over low returns on capital. Again, without applying it, it sounds kind of abstract. So I'm going to take you back 20 plus years. 1999, I estimated the growth rate for two companies that one of which was soaring at the time, Cisco. We talked about how it was one of the stars of the 1990s. And to see why it became the star that it did, take a look at what Cisco's numbers look like in 1999. First, the reinvestment rate was 107%. Pause right there. When I say the reinvestment rate is greater than 100%, what am I telling you that Cisco did in 1999? How do you reinvest more than your after-tax operating income? It has raised fresh capital, either use fresh equity or fresh debt. In this case, it raised fresh capital. So 107% reinvestment rate. That's pretty impressive, right? But what made it even more impressive, while they were reinvesting this huge amount, they kept a return on capital at 34%. Usually when companies reinvest huge amounts, like this year, Microsoft is going to have a reinvestment rate that exceeds 100%. Why? Because they bought Activision. But this year, the return on capital is not going to be that impressive because it's going to come into the book value. It's going to lower. They might make it up in the future, but when companies reinvest a lot, usually it comes at the expense of the return on capital because you're taking less attractive projects. Cisco pulled out one of the toughest tricks in business: reinvest a lot and reinvest well at the same time. And the way you'd have rewarded Cisco, if you assumed they could keep doing what they were doing, you take the product of those two numbers, you get an expected growth rate. High reinvestment rate times high return on capital is a high growth rate. In contrast, Motorola, it's not a bad company. In fact, it's a pretty well-run company. A reinvestment rate of 53%. Not bad, right? And a return on capital of 12.18%, not bad. You multiply not bad by not bad. What do you get? Not bad. Their growth rate is not bad, 6.45%. When you see companies with growth rates of 5, 6, 7%, every company wants to grow 30%, right? I mean, Motorola would like to be like Cisco. The problem is with the fundamentals you have, you can't push the limits of growth beyond those fundamentals. So we looked at growth in earnings per share, retention ratio times return equity, growth in non-cash net income, which is equity reinvestment rate times non-cash ROE. Now we looked at growth in operating income, which is reinvestment rate times return on capital. Let's see if these lessons have kind of ingrained themselves, because all of these calculations, there's a common element, which is an accounting return on equity, return on capital. And return on capital somehow has become this magic, what I don't even know what to call it, magic word at many consulting firms and investment banks. In fact, I've gone into consulting firms where people talk about ROICs all the time. First time I heard it, so what are you talking about? ROIC, of course, is return on invested capital. It's their way of saying, you don't know what a ROIC is, you can't be one of us. It's like a secret society. But I'll be quite honest. I computed returns on capital for every publicly traded company at the start of every year, but this number terrifies me. I'll tell you what terrifies me about the number. What's in the numerator? After-tax operating income, which is an accounting number. What's in the denominator? Book value of equity plus book value of debt minus cash, which is also an accounting number. I am completely and totally at the mercy of accountants when I compute this number. Everything accountants do, good or bad, is going to affect this number. In fact, when I compute this number for all companies, I make two adjustments for every company. I capitalize leases. I've been doing that for 30 years. Now the accountants have caught up, but I also capitalize R&D. But there are other things accountants do that I can't clean up for as easily. Let me give you an example. Let's assume you have a company that has made a terrible investment 5, 6 years ago. Everybody knows it's terrible. You've reached a stage where you're beyond denial. What are accountants going to do with that company because you made this terrible mistake? What are accountants allowed to do to reflect mistakes? You can write it off. You take a big charge. You're saying that's sensible. You should take that investment off your books. BP, as you know, in the last week has walked away from its partnership, its joint venture that it had in Russia with either Gazprom or Lukoil or whoever it was. That's going to create about a $5-6 billion loss. So you know what the accountants are going to do? They're going to write off $6 billion. You're saying, so what? That's the sensible thing to do. In the year that it happens, you can see why it happens, right? You can say, oh, that's why it happened. But let's say it's 2 years later, you're looking at this company. When you write off 5 or 6 or 8 billion, what does that do to your book value? It lowers your book value. So 2 years later, when I look at this company and I compute the return on invested capital at this company, I'm using this depressed book value that you got and I'm going to conclude that your company is taking great projects. If I'm not aware of the fact that you took off 10, 15, or $20 billion from your book value, I might come to this misguided sense of you have great projects. Look, your return on capital is 25%. I don't know whether any of you have trouble sleeping. Maybe this class is giving you the trouble, but I think I have the antidote. I have a paper on estimating return on equity and return on invested capital. It's 65 pages long. It's complete drudgery. It was so boring that I fell asleep multiple times while I was writing the paper. I had to drink like Red Bull after Red Bull to kind of keep going through. Yeah. But it's a paper about cleaning up accounting returns. And basically, it's about whatever accountant's done, how do I reverse it? Because in a sense, you can see the cleaning up has to go back over time, all the restructuring charges over time. And the reason I make such a big deal is if you're going to build a castle on this number, like many consulting firms have done, you better be clear about what's wrong with this number at many companies. So I use returns on capital, but be clear about the fact that everything accountants do will affect that return on capital. Now I'll send you a spreadsheet, where you can do that for your company. But once you get that number for your company, take a look and say, do I trust that number? Is it a number that really reflects what I think about this company? And sometimes your conclusion might be, it looks great, but I don't trust it. Let's do one final growth scenario. So we've talked about growth in earnings per share, growth in non-cash net income, growth in operating income. But those equations that I showed you are called sustainable growth equations. People use them all the time, but they're built on an assumption that sometimes needs to be stable. They're built on the assumption that your returns on capital are now in steady state. They're not going to change over time. Your margins are stable. And the truth is, in many companies, that's not going to be true. Your return on capital will be changing over time. And when your return on capital changes, you get a second order effect. Let me give you a very simplistic example again. Let's say you have a company that has $1 billion of capital invested, has a 5% return on capital. It's reinvesting nothing. So if I stop right then, say 5% return on capital, your reinvestment rate is 0. What's your growth rate? Use the equation, what's your answer going to be? 0 times 5% is 0, right? What if I told you that next year, this company is going to become more efficient and improve its return on capital from 5% to 10%? It's reinvesting nothing, but it's getting more efficient. So how much will it make as income next year? It made 50 million this year. 5%, it's going to make 100 million next year. It's going to have a growth rate of 100%. You see where I'm going? You can sometimes get growth by improving returns on capital. It's called efficiency growth. And sometimes if your return on capital is decreasing, cut in the opposite direction. So again, when you think about expected growth for your company, start with the sustainable growth equation. But if your company has the potential of changing returns on capital over time, there's going to be an additional layer, extra growth you're going to get if you have an improving return on capital or a decrease in your growth rate. Again, I'll use Motorola to illustrate this point. When I valued Motorola in 1999, it showed you the return on capital was like 12%. Not great. But it was on a pathway of improvement. It looked at the trend line. It looked like it was improving its return on capital. I made the assumption that over the next 5 years, that return on capital will go from 12.18% to 17.22%, which is the industry average. So I'm telling a story about improving returns on capital. I also assumed that on the new projects they would take from this day on, they would earn the 17.22%, but on the existing projects, it will take a while to improve the return on capital. Let's talk about the growth you're going to see in Motorola's earnings with that assumption. First, if you're making 17.22% in your projects and you're reinvesting 52.99%, you take the product of those two numbers, you get like 8.7% as your growth rate. So if this company had no improvement in return on capital, its growth rate would be 8.7% a year, every year for the next 5 years. But remember the second component, because they're improving the return on capital from 12.18 to 17.22%. If this equation looks a little difficult to deal with, just take the difference and divide by 5. Look at the growth you're going to get each year. Because you're improving your return on capital, your growth rate, instead of being 8%, is going to end up being 16.3%. Put simply, if you have a company with low returns on capital that you think will improve their returns on capital, you'll get that bonus growth from improved efficiency. And that bonus growth can allow low growth companies to become high growth companies, at least for the near term. Once you've hit that return on capital, there'll be no more growth. But at least till you get to that point, you're going to get that efficiency growth. So here's a test for you. I'm going to show you 5 companies. They all have exactly the same bottom line growth. They're all growing at 10% a year. But the way they're getting there is very different. I want to look at the 5 companies and rank them as an investor from highest quality growth, highest quality being growth that delivers the most value, to lowest quality growth, which could be growth that destroys value. Let's start with the easy, those extremes first. Which of these 5 companies delivers the highest quality growth and why? They all have 10% bottom line growth rates, but one is delivering a lot more value than the other 4. Which one is the highest quality growth and why? What is it about one that gives them the highest quality growth?
It has the lowest, one of the lowest reinvestment rates, but the highest.
Now focus, it's a high return. So basically they're getting a 10% growth rate by taking projects that make 15% returns. So firm 1 is going to be a highest quality growth. I think now using that same dimension, which is the worst company in terms of growth, which is district. Take firm 3. It's got 10% growth rate, but think of what it had to do to get that 10% growth rate. It reinvest 200% in projects that make 5%. If your cost of capital is 10%, company 3 is destroying value at an exponential pace. Company 1 is the best. Company 5 is the worst. Let's look at the remaining rankings. Company 2 is just running in place. It's doing nothing. You see what I mean by running in place? It's growing, but it's earning a return on capital roughly equal to the cost of capital. It'll become bigger, but it's not creating value. Companies 4 and 5 are getting efficiency growth. You know what I mean by efficiency growth? Their growth rate would have been much lower if they hadn't seen improvements in return on capital, but because they saw that improvement, they were getting the extra growth rate. So if I were to rank these companies, company 1 would clearly be the best company. Companies 4 and 5 would be right below, because in a sense, they're getting that efficiency growth. Then you'd get company 2 because it's basically running in place. And at the very bottom would be company 3 because it's actually destroying value as you grow. When you look at your company, you're going to see a growth rate for your company. Some of your companies will have 15, 20, 20. It's easy to get impressed by growth rates. But take a look under the surface because some of these companies are growing and destroying value. And some of these companies are growing and increasing value. And you want to be able to separate the 2 groups. So I'm going to leave the growth section with a very generic way of thinking about growth. And this you can use on any company, young money losing, startup company, mature company, declining company. In fact, all of my spreadsheets are built around this way of thinking about growth. So if any of you have been doing the valuations of the week, what I'm going to describe next is going to be something that looks very familiar because every single company I value, I've used this structure to value the company. So here's what I'm going to do. You give me a company to value. The margins are changing. The returns on capital are changing. I can't use a sustainable growth equation, right? Because if everything is changing, that equation is not going to work. So to get an expected future earnings and cash flow for the company, here's what I'm going to do. I'm going to go to the top of your income statement. I'm going to project revenues out. Because in the other approaches, I was just working with earnings. Here, I'm working all the way from revenues. I'm going to project growth in revenues. Now, what's going to drive whether that number is going to be a small number or a big number? It's going to be a function of, is your company a small company in a big market or a big company in a mature market? How quickly can it grow? And I will leave those judgment calls, but you will get a revenue growth that determines what happens to your company's revenues over time. If you have a company that's in a declining business, your revenue growth rate can be negative. Your company revenues can decrease 5% a year for the next 10 years. So anything is possible depending on the company. So you start with revenue growth. Second stop, I'm going to ask you, what's going to happen to your margins over time? Now, do you see why you can use this for money-losing companies? Your margins right now are negative, but if you can tell me what will happen to margins over the next 3, 5, 7, or 10 years, I'm going to plot out a pathway to get you from existing margins to those future margins. What's that going to do? It's going to convert your losses into profits. Now, of course, in making this judgment on what you can generate as margins, you got to factor in what business you're in. If you're a software company, your margins can be sky high. Why? Because it doesn't cost you much to produce an extra unit. If you're a manufacturing company, your margins can be much lower because your cost of producing a car or the steel you make is a high percentage of your revenue. And then I'm going to put closure here. I'm saying, look, you want high growth, That's fine, but how much will you need to reinvest to get this growth? And I'm going to tie how much you reinvest to what your revenues are doing. You see why this holds managers accountable? Because in each variable, if you ask managers, would you like low growth or high growth? What's their answer? I'd love high growth. Okay, you can have the high growth. Would you like low margins or high margins? I like high margins. Okay, I'll give you high margins. Then you ask them, how much do you plan to reinvest? They say, look, I don't want to reinvest. That's so much. You can't have your cake and eat it too. If you want revenue growth, I'm going to ask you how much will you need to reinvest? And to capture how much you reinvest, I use a ratio that you're going to see in all of my spreadsheets. The ratio that still throws people off. It's called a sales to capital ratio. It sounds fancy, but basically revenues divided by invested capital. Remember the invested capital I used to compute return on capital? Instead of dividing after-tax operating income, I divide revenues by invested capital. You're saying, what does that tell me? It tells me for every dollar of capital I invest, how many dollars of revenues I can create at this company. So if you're a company that's efficient about delivering growth, that number should be much higher. If you're a company that is in a capital intensive business, you're an infrastructure business, the number can be much lower. So let's try this. I'm going to pick a company that you're all familiar with, that you probably have used somewhere in your travels for the last few years. In November of 2020, Airbnb went public. And people were surprised at the time. You know why they were surprised, right? November of 2020, COVID's hit, everything shut down. Why would you go public in the midst of a global economic shutdown, which especially hit the travel business? I thought it actually made complete sense for them to go public, because in a strange and perverse way, COVID made Airbnb stronger relative to their competition because it handicapped the competition. Sometimes good things don't have to happen to you, but bad things happen to your competition. It's the same thing as good things happening to you. So while Marriott and Hilton were being handicapped, Airbnb was walking away with far less pain being inflicted on it because of its cost structure. So everybody knows how the Airbnb business model works, right? It doesn't own apartments. Basically, it's an intermediary. You have a house or an apartment that you want to rent out. You list on Airbnb, and I rent your house. Airbnb gets a slice of whatever I pay. Does anybody know how much that slice is? How much of what you pay on a typical Airbnb ends up with Airbnb? It's about 14%. It's 14% because it used to be 12.5% to 13%. It's now up to 14%. The way they collect the money is also changed. It used to be they collected both from the renter as well as so now they've changed the business model. It's about 12.5% to 14%. It's an intermediary. And that's going to become a critical part of my story. So when I sat down to value Airbnb, the question I wanted to ask was, what would big revenues look like for an intermediary in the travel business? Because without a sense of that, I can't value Airbnb. So what I looked at was what's called gross bookings. This is the total money spent on Airbnb. Remember, only a percentage of that goes to Airbnb. So the revenue in 2020, leading into the IPO, was about 14% of the revenue. So you can see the 3.6 billion divided by the 26 billion would give me their slice. So my task is laid out for me, right? To value Airbnb, I've got to make a judgment on first, what will happen to gross bookings over time at Airbnb? And second, what will happen to the slice of those gross bookings that Airbnb can keep? So I'll tell you my story. The reason I say my story is as I listen to my story, I hope you say, look, I'd have told a different story. And I'd encourage you to think about different stories for Airbnb. In my story, I see Airbnb succeeding on two levels. One is by increasing the size of the hospitality business, bringing in people into the business who otherwise wouldn't have been. Just like Uber changed the car service business by doubling and tripling its size in some parts of the country. And getting a major slice of the total market. It's an upbeat story. My gross bookings for Airbnb go from 26 billion to 155 billion. You're saying, how do I know whether 155 billion is feasible? I looked at two other intermediaries in the space, Expedia and Booking.com. They've been around a lot longer than Airbnb. The difference is they get the bulk of their gross bookings through the traditional hotel business. Booking.com in 2019 some going back pre-COVID, because 2020 was a disaster for everybody, had about 96 billion in gross bookings. When you sit down to value young companies, sometimes getting perspective on what big revenues will look like for that company is critical. If you're going to value Tesla, and if I ask you, what do revenues look like for a big automobile company? You say, I have no idea. And you have no business valuing Tesla. So in this case, looking at Expedia and Booking.com gave me a sense of what big revenues were. I think Airbnb will be bigger than either of those companies. Right? Expedia is 108 billion, Booking does 96 billion, because it's not just reaching hotels, but it's reaching this other business that would not go through Booking or Expedia as easily. So I'm telling an upbeat story of revenues increasing to make Airbnb the biggest travel intermediary on the planet by far. Now, of course, the next question is, what percentage of those gross bookings would stay with Airbnb? I don't think much is going to change in that 14%. Just like Uber's slice of the revenues has stayed pretty stable. So in my story, it's about 14%. So you see that revenues climb with the gross bookings. So over time, my small revenues become big revenues. And the growth rate you see here is an entire concoction. Basically, no, it could be any growth. If as long as I know my end value is to be about 150 billion, then I can start at 45, I can lower to 35, but the growth rate in a sense is designed to get me from where I am now to where I expect them to be 10 years out. Take a look at the operating margin. At the time I valued Airbnb, it was losing money. It was losing a lot of money. But here again, my upbeat story kicks in. I assume that as they get bigger, economies of scale will kick in. What does that mean? Your costs will rise, but not at the same rate as revenues. And as that happens, negative margins are going to become positive, and over time, those margins will converge on 25%. You know what the typical margins for a hotel company are? Like if you take Hilton, which is, I think, the prototypical hotel company's margins are about 11%. Why? Because it's expensive to run a hotel, all those costs. I know that Airbnb is not in the hotel business. They don't own the hotels. So to get a sense of what their margins were, I looked at Expedia and Booking.com, and Booking.com's margins are about 35%. Expedia's are much lower. You know why they're much lower? Expedia actually buys hotel rooms from hotels and then rents them out. So it actually is in this other business of actually trying to make money. It's a much lower margin business. I'm not saying one company's better than the other. They have different business models. It's not even arbitrage. They're just basically buying the hotels, hoping that they can mark up prices so they can assess demand better than the typical person. So they view that as their skill set.
Oh, they buy it first.
They buy it right when you book it. No. They buy, for instance, they buy the hotel rooms in Virginia Beach during spring break for a hotel. And then when you want to rent those rooms, you're now renting an Expedia room. So it's a different business. You're no longer just an intermediary. I don't think Airbnb has any plans of getting into that business. So over time, I see the margins improving towards Booking.com's margins. Booking's margins are higher simply because they work with a lot of traditional hotels, which allow for higher margins. Airbnb, I think, will have to end up with margins lower, but still pretty healthy margins. You see the pathway, though? Revenue growth makes my small revenues to big revenues. My margins improve over time. And here's the last piece of the puzzle. As my revenues increase, I keep track of the change in revenues every year. So if you look at this column, that's a change in revenues every year coming from the previous year. I assume, and this is my estimate, that for every dollar that Airbnb invested gets about $2 in revenues. I base that on looking at two things. One is Booking.com and Expedia. I looked at their revenues to invested capital. I also looked at Airbnb's own history over time. And roughly speaking, it looked like for every dollar they invested, they got $2 of revenues. Remember, the higher that number, the less you have to reinvest. But in this case, if I use that $2 in revenues for every dollar of capital, to get a change in revenues of 1.065, just take the 1.065 divided by 2, I get my reinvestment. What's in that reinvestment? Everything. Net capex, change in working capital, R&D, acquisitions are all in there. You know why I'm estimating it as a consolidated number? Because I don't know what Airbnb will have to reinvest in to grow. I know they'll have to reinvest, but I don't know what they'll have to reinvest in. And guess what? Airbnb doesn't know right now what they'll have to reinvest in. So what I'm doing is I'm setting money aside to cover the growth projections I have. But in this upbeat story, I'm telling about Airbnb becoming the largest travel intermediary in the world with these great margins. Take a look at my free cash flows. Year 1, year 2, year 3, year 4, year 5, year 6. For the next 6 years, I have very negative cash flows. You know why? Because I'm so optimistic about the company. It sounds like an odd thing to say, but you see why my optimism is making my cash flows more negative? Because what am I optimistic about? High growth. That high growth requires reinvestment. And that's actually one of the ironies in valuation. The more upbeat you get about a company, the more you got to be willing to accept that the cash flows in the near term are going to be much more negative because you want to get that growth. So take a look at that any of my valuations, or even the Airbnb. It's on my whoever's on Zoom. If you could just mute yourself, I can hear you. Yeah. So take a look at the Airbnb. It's on my blog post, so you can go take a look at the valuation. Change the numbers, because if you don't believe that the margins are going to be as high or they're going to be much higher. No, but the 3 levers you have under your control are revenue growth, margins, and the sales to capital ratio. Now, I might be overstating it, but you give me any business model for any company. My quest is to convert that business model into these three sides of this triangle. What's it going to translate into in terms of revenue growth? What's it going to mean in terms of margins? And what's it going to mean in terms of reinvestment? So now let's talk about the terminal value. First, let's get a reminder why we need a terminal value. We need a terminal value because without it, we're lost. The value of a company is the present value of its cash flows in perpetuity, right? And none of us wants to be doing an Excel spreadsheet with 16,000 columns. Maybe you do, but I don't. So terminal values are a way of stopping in year 5 or 10, saying, look, I'm tired. I'm going to estimate what the value of my company is going to be at the end of year 5 or the end of year 10. That's what terminal value is designed to do, is to put closure. Because you can't ignore what happens after year 10. You got to put a number on it. And broadly speaking, there are 3 ways in which you can estimate a terminal value. One, which I said you should never use, is the multiple approach. The reason I've listed that there is because so many banking DCFs use pricing multiples to get a terminal value. But if you're doing an intrinsic valuation, you need a cash flow. You can either get the cash flow as a liquidation value. I'll tell you when I use liquidation values in valuation. Let's say you run a plumbing business and you are the plumber. You're 65 years old. You tell me to value your business. It's kind of silly for me to project out for 5 years and then have a perpetuity after that, right? Because without you, there is no business. So here's what I'm going to do. I'm going to project your cash flows for the next 10 years. I'm going to ask you, how long do you want to work? 10 years, okay. And presumably your son or your daughter doesn't want to work in this business anymore. So those are all questions I would ask. But if there's nobody ready to take over the business, here's what I'm going to do. I'm going to project the cash flows for the next 10 years. At the end of the 10th year, I'm going to shut the business down. When you shut the business down, I'll sell the trucks off. I'll sell the land off. I'll repay my lease. I get a salvage value, liquidation value. With private businesses, especially key person private businesses, you know what a key person is? A private business built around an individual. Plumbing example, doctors' practices, dental practices. I have no qualms about using a liquidation value because it makes sense. But for publicly traded companies in a continuing business, you're probably being too conservative. If I valued Facebook by projecting cash flows in the next 10 years, in the end of year 10, just liquidating its assets, I'm going to get a really small value for the company. Because what assets does Facebook have? What am I going to sell? Right? I can't sell users. It's not like I own the users. Maybe I can try to sell pieces of the platform. So for publicly traded companies, we tend to use the stable growth equation. And it's the most used and misused equation in all evaluation. To see why, take a look at what that equation gives you. You project out cash flows for the next 10 years, and I ask you to estimate the terminal value at the end of year 10. Here's the equation. To get the terminal value at the end of year 10, I need cash flows in year 11. Remember that. You always need the next year's cash flow. So to get terminal value in year 10, don't use cash flows in year 10. You need the cash flow in year 11. and you divide that cash flow by R minus G. You're saying, what's R? You're doing an equity valuation. R is going to be the cost of equity. If you're valuing the firm, it's going to be the cost of capital. G is your growth rate forever. When you look at that equation from a mathematical perspective, if you hold everything else constant, you keep R fixed, you keep the cash flow fixed, and you move G towards R. So you start with the 2% growth rate, then you make 3. Remember your cost of capital, let's say it's 8%. Just go from 2 to 3, your value goes up. 3 to 4, it goes up even 4. And if you don't stop, you know where you're going to end up, right? You're going to end up with what I call Buzz Lightyear valuations. You're going to infinity and beyond, right? You get if your G is equal to R, what happens? Your terminal value implodes on. Now, Toy Story might be your favorite movie, but you cannot make your DCFs a reflection of infinity and beyond. So I'm going to put in some guardrails when you do terminal value to keep you from destroying your own DCF. Let's take a look at that equation. It says growth rate forever. Think about what that growth rate can look like. I've said this before, but there's no harm repeating it again. If it's a growth rate forever, mathematically, that growth rate cannot be greater than the growth rate of the economy in which you operate. So if you're a global company, it could be the global growth rate. If you're a domestic company, it could be the domestic growth rate. Everybody agree with that? You cannot have a company grow at a rate faster than the growth rate of the economy. You still have people ask you, why again? Don't hang out with people like that in the first place. But if they, just give them 2 numbers on this Excel spreadsheet, let the one bigger and one smaller, take the smaller number and let it grow at a higher rate than the larger number and see what happens over time. So your growth rate cannot exceed the growth rate of the economy, because if it does, your company is going to become the economy. And then what? Oh, globalization, keep going. Then what? Interplanetary travel? I mean, there are assumptions in valuation where you and I can agree to disagree, right? Revenue growth over the next 5 years. If you say it's 30%, I say it's 15%. I can't prove you wrong. You just have a different story. But in stable growth rate, if you say, my company is going to have a 6% growth rate forever in US dollar terms, I'm going to say, no way. It can't happen. That's impossible. This is a fairy tale. So your growth rate cannot exceed the growth rate of the economy. You say, how the heck am I going to get growth rate in the economy? I'm going to give you a very simple way of doing it, which I've already used before when I did my implied equity risk premium, but it cannot be greater. Can it be lower? Let's say the growth rate in the economy in nominal terms is 3%. Can your company grow at 2% a year forever? Sure, right? Some companies, can it grow at 1% a year? Absolutely. Can a company have 0% growth rate forever? Why not? Can a company have a minus 3% growth rate in perpetuity?
No,
Why not?
they're out of money.
No, it just gets smaller over time, right? Basically, if you take a number and you put in a minus 3% growth rate, it'll eventually disappear. It'll still hang in there, but it'll be almost nothing.
You're gonna find a limit of that.
Why does it matter, right? Companies can get smaller and disappear over time. In fact, in the real world, that is closer to the truth than what we assume in traditional DCF. In traditional DCF, have you noticed that we make every company a dinosaur? A huge company. Every company becomes this $1 trillion company. You can have negative growth rates in perpetuity and leave that door open, because there are some companies where I think you get more realistic estimates of value by putting in a negative growth rate in perpetuity. Help me out. What sectors or what types of companies do you think you're going to get to your turn and say, I'm not going to let this company grow anymore. I'm going to put in a minus 3% growth. Yeah.
Utilities.
One is a disrupted company. If you're valuing a taxi cab in New York City, you know what Uber has done to the taxi cab business in New York City? How do you, in fact, you should know this since you live in the city. What do you need to operate a taxi cab in New York City? A medallion. You know what that medallion cost in 2008? It cost almost $1.5 million in 2008. You know what it's going for right now? In fact, I would be surprised if we got more than 150,000 for that same medallion. What happened? Uber happened. Disrupted company. So if you're valuing a Bed Bath and Beyond, I know today was all this excitement, some GameStop guy took a position. But what kind of story are you going to tell about Bed Bath and Beyond that's an uplifting story? This is a truly depressing store to walk into. Have you ever walked into a Bed Bath and Beyond?
Yeah.
You don't even know what they're selling. You walk through and say, what is this store outside? It's basically knickknacks and stuff you don't need for a house that you're not going to furnish in the first place. So if you're valuing a brick and mortar retail company now, there are a few that are exceptions. Costco, maybe Target, maybe Walmart, but almost every other brick and mortar retail company I look at, and I'm thinking about long-term growth, I'm more likely to think of negative growth rather than positive. And that includes companies like Best Buy. There's really no end game here where you're going to get 3% growth forever. You know, any other sectors where you think negative growth? Think ESG and think anti-ESG.
Oil.
Fossil fuel companies, right? You're a mining company. Now, I don't like ESG. I've talked about all the things that can go wrong with ESG. But let's face it, if you're an oil company, the end game here is not upbeat. Tobacco companies, they still have an addiction. They still have a core market, but the market's getting smaller. There are fewer people smoking now than 10 years ago, 20 years ago, 30 years ago. What I'm trying to say is there are some companies where you get to year 10, your growth rate in perpetuity is not plus 3% or plus 2% or even plus 1%. It could be minus 3% or minus 5%. And trust me, your discounted cash flow valuation will still work. But your terminal value will then reflect the reality you see in this business, that it's a shrinking business. Yeah. It could be year 3, year 2. It could be whenever you're tired, whenever you think your company is, because to do this, you got to assume a constant growth rate forever, right? So if I'm valuing an Airbnb, I can't make it in year 2 because it's still growing too fast. So if your company is still growing at 10%, you can't stop and do a terminal value because it's too abrupt. So there's got to be some degree of transition. So when you look at companies, you got to ask, when will I put my company in stable growth? And we'll ask that question for companies. The answer is going to be different for different companies, but it could be in year 10, it could be in year 5, it could be right now. If your company is already a mature company growing at a rate less than or equal to the economy, you can just estimate the value right now in one equation. You're done. You don't have to project any cash flows. Yes. So that's what I'm going to talk about next is why that's because there's an estimation challenge, right? Which is how do we get a nominal growth rate for the economy? And if you remember the implied equity risk premium calculation, I made the assumption that the risk-free rate was a proxy for the nominal growth rate. I'm going to come back and explain that, but you had a question that or when you talk about a currency where the government bond is not default free, you'd have to do the cleanup. Once you call something risk-free, that becomes your risk-free base from this point on. But let's take a look at, because this, I think, is the most controversial part of what I do in valuation. I get more pushback on this issue of why does the growth rate in perpetuity have to be less than or equal to the risk-free rate? I'll make my best case. It's not a perfect case, because if you decide to do what I do, you're going to get a lot of pushback from people around you if you're in the valuation business. So here's my argument for why. In the long term, the risk-free rate is the best proxy for the nominal growth rate in the economy. I don't know whether you remember this equation called the Fischer Equation. The Fischer Equation, you take a risk-free rate, you can break it up into two components, expected inflation and an expected real interest rate. So I'm not doing anything, I'm just decomposing. What goes in a nominal growth rate in the economy? Expected inflation plus an expected real growth rate. So the inflation cancels out. The question is, what's the relationship between expected real interest rates and expected real growth rates? Again, I'm going to draw on the long term. In the long term, your real interest rate is a good proxy for your real growth rate. In other words, if you have a real interest rate of 2%, and your economy is growing at only 1%, you're going to have a problem. You know why? Because you don't have enough goods and services to actually pay people that 2%. So in the long term, the risk-free rate becomes a proxy for nominal growth, which is incredibly depressing if you think about being in the US or Europe, right? Because what have I just told you? That the nominal growth rate in the US economy in the long term is going to be less than 2%. Because the T-bond rate is less than 2%. And if you look at the last 60 years of data, and you do a very simple test, at the start of every decade, you take the T-bond rate, and you make it the predictor of growth in that decade. And then you run a test against the 50 top economists at that time making forecasts. For the last 6 decades, the T-bond rate has been a better predictor of nominal growth rate in the US economy than the 50 top economists put together. I don't even know why we waste our money on these guys or these people who are part of this group. Let's take the T-bond rate. So my first defense for using the risk-free rate is it's worked very well in the past. If you look at the risk-free rate and look at nominal growth, take a look at the breakdown of periods. In periods where the inflation rate is high and real growth is high, the T-bond rate tends to be high. And periods like the last decade when those numbers are low, the T-bond rate, it's not perfect, but no predictor is going to be perfect. So over time, growth and risk-free rates have been locked at the hip. If that doesn't sell, I'll give my second reason for using the risk-free rate as my proxy for real growth. Most of the time when you value companies now, people look at the T-bond rate, the first reaction, that number looks really low. In other words, there's this general sense that interest rates are too low, they're going to go up. So if I use that really low interest rate as my basis for computing cost of capital, your pushback is your cost of capital is really low, right? And in a discounted cash flow valuation, if your discount rate is low, your value should be too high. Here's how I keep my valuations on at least on a steady front. If I use a low risk-free rate and I give you a low cost of capital, to be consistent, I also make you use a low growth rate in perpetuity to go with that low risk-free rate. In other words, what helps you on one side will hurt you on the other. What one hand gives you, the other hand will take away. I'm trying to keep your valuations internally consistent. Because here's what will devastate your valuations. If you use today's risk-free rate to come up with your cost of capital, and then you use a nominal growth rate by looking at the last 50 years, which is like 4% as your growth rate in perpetuity, I'll save you the trouble. Everything you look at will look overvalued, but you get this huge value. So if your risk-free rate is low, your growth rate is going to be low. If you look at my spreadsheet, I give you a chance to reset the risk-free rate after year 10. So if you really feel the risk-free rate is too low now, I say, okay, tell me what the risk-free rate will be after year 10. You want to use 4%? Use 4%, but then your growth rate can also be 4%. But if you want to leave it at 1.5%, I'm not going to let you change just the growth rate and leave the risk-free rate as is. So if anybody pushes you on it, just point out that you're willing to take any risk-free rate they want to use, as long as you tie the growth rate to the risk-free rate. What you cannot afford in a valuation is for those two numbers to get disconnected. So my argument for the risk-free rate being the cap on the growth rate is partly practical because it keeps my valuations consistent, and partly empirical. This has worked pretty well in the past because historically the T-bond rate has been a pretty good predictor of the nominal growth rate of the economy, at least going back over the last 60 years. So just as a tangent, about September of 2019, I valued Heineken, Dutch brewer. And I did it for a European audience. And in the audience, there were 7 people from the Heineken finance group. And when I initially did the cost of capital, I started with the risk-free rate, which in euro terms at that time was a negative number. And I left it negative. They were very happy. You know why, right? Because with a really low, with a negative risk-free rate, the cost of capital is only 5%. So they're feeling pretty good. They said, you're giving us a 5% cost of capital. You're going to come up with a really big value for the company. Then I got to my terminal value calculation. And the growth rate I gave them in perpetuity was minus 0.5%. And they didn't like that at all. They said, that's so unfair. You're giving us a negative growth rate. I said, you didn't complain when I started with the negative risk-free rate. If you want one, you got to live with the other. If you want me to use a 3% risk-free rate in euros, I'm willing to do that. But then your discount rate is going to be 7 or 7.5%. And I'm going to allow you to have the higher growth rate. So that again is a point I make about consistency, is if you want to use a negative risk-free rate, it's not going to blow up your valuation as long as your growth rate is also negative. What will blow up your valuation is if you leave the risk-free rate negative, but use a 3% growth rate in perpetuity. Then you're going to overvalue the company because you've disconnected those two assumptions. So in this case, actually, I ended up finding Heineken to be what, 60 euros per share. It was trading at 93. So in spite of giving them a low cost of capital, I wasn't coming up with this outlandishly high value because my growth rates were linked up to my risk-free rates. Now, the question about how long before you put the company into terminal value, right? Should be year 5, year 10. My only advice is don't wait too long. That's a good question. Now, I've never used more than 10 years, and I get a lot of pushback on this. And the reason I get pushback is, are there companies that have grown for longer than 10 years? Absolutely, right? We can name them. There's Apple, there's Microsoft, there's GE, there's CocaCola. What does the fact that we can name these companies tell you about these companies? They're the exception rather than the rule. You know what the median growth period for a growth company in the US is? 3 to 5 years. That's how long it takes before you converge on the industry average growth rate. Why does growth dissipate? Many of these companies, when they go public, have 80%, 75%, 70% growth rate. What causes growth to dissipate? I'm sorry, what?
Like the TAM, total addressable market.
One is the scale goes up, right? The company gets bigger, so that 70% growth becomes more difficult. The second is when people notice you're growing, what do they try to do? They try to imitate you. There's competition that comes in. The reason growth is so fickle, fades so fast for most companies, is because you get competition coming in. So the question you're asking is, how long should I wait before I put my company to stable growth? I'm going to turn the question back on you, but the question I'm going to ask you is, what kind of competitive advantages does your company have? Do you see why that matters? If you have a company with significant competitive advantages, your growth can last much longer. You're valuing Moderna and you use a 15-year growth period. I get it. Because they patented the mRNA vaccine like 3 years ago. They've got 15 years left on that patent. You have complete protection against competition. Doesn't mean your margins won't change, your growth rate won't decrease, but you have a very solid basis for using a 15-year growth period. In contrast, if you take, I remember when Groupon went public, and everybody was impressed with how quickly they were growing. And my reaction was, what's so special about Groupon? They got my email address before Living Social Media and 3 other guys. There's nothing special about a Groupon deal. Nothing I saw on Groupon led me to believe that this was a company that could maintain that growth rate. And at Groupon, the growth faded really fast because there was nothing they could keep the competition out. I don't do any consulting, but a lot of people who start businesses try to get some informal free consulting advice. So the question I always ask them, and after they describe their product or business, is, what do you plan to do if you succeed? It completely throws them off, because usually the question they get asked is, what do you plan to do if things don't work out? Yeah, I know what you plan to do if things don't work out. You're going to shut down. What else are you going to do? My question is, what do you plan to do if 6 months from now, you're having 150% growth in revenues? You know, what do you mean? Because you know what's going to happen if you have 150% growth in revenues over the next 6 months. Other people are going to notice you. They're going to come after your business. Tell me what you've put in place to keep the competition out. And if you can tell me I've done this, this, and this is what I plan to do, I'm much more likely to give you a higher value than if you said, I'll think of something when they come in. It's not going to work. I think if you're building a business, and I know many of you are attracted to being entrepreneurs, you want to start your business. What you want to think about is, what can you put in your business that'll keep the competition out when you start to do well? Because if that's not in place, you're going to succeed, you're going to grow fast, and before you know it, your growth is going to get wiped out because somebody with deep pockets came into your business and essentially took away a business from you. So when you think about the length of the growth period, it's not a number as much as a reflection of what you think about the company. I talked about storytelling. What's your story for this company? What are its competitive advantages? Because the answers to those questions are going to determine whether you give this company a 15-year growth period, like I did for Moderna, or only a 5-year growth period for a company where I feel there are no competitive advantages in place to keep the competition out. So what's the growth rate? Cap the growth rate. Don't wait too long. You get to year 10. You're ready to compute the terminal value, right? Remember when we talked about growth, we talked about how growth and reinvestment are locked at the hip. That lesson applies in spades when you get to your terminal value calculation. So you get to year 10, you say, look, I'm going to make my company grow at 2% a year forever. You say, okay, how much will you need to reinvest to get the 2% growth rate? And remember, we're talking forever now. So there can be no efficiency growth. This has to come purely from what I call sustainable growth. You say, what does that even mean? What I said, in steady state, your growth rate is the return on capital times the reinvestment rate. Let's say you want to grow at 2%. Your return on capital is 10%. your reinvestment rate has to be 20%. It's not a choice. You will have to reinvest 20% of your after-tax operating income every year in perpetuity to get that 2% growth rate. You've all seen the traditional terminal value calculation, which is free cash flow to the firm next year divided by R minus C. This is my version where I take the after-tax operating income and I multiply by 1 minus the growth rate. You say, what's the growth rate divided by return on capital giving me? It's giving me the reinvestment rate I will need to keep this company going. It's essentially a rewriting of a terminal value calculation where what I have to reinvest is written in terms of what's your growth rate and what's your return on capital. I'm going to use that to kind of look at what happens to your terminal value as your growth rate changes. Remember the start of the class test, I said, what will happen to terminal value if I make your growth rate 2%, 4%, 6%? Take a company. It has $100 million. It's the company that I described to you, 100 million, 10% cost of capital, 0% growth rate. He told me it was worth $1 billion, right? If your return on capital is equal to 10%, look at what happens to your terminal value as your growth goes from 0 to 3%. It doesn't change a cent. My terminal value is almost locked in place as my growth. That's absurd, right? Growth goes up. How come terminal value is not changing? What is happening in terms of mechanics here that's keeping my terminal value stable as my growth goes from 0 to 3%? What does it mean when you earn a return on capital of 10% and your cost of capital is 10%? You grow, but what kind of projects are you taking? You think in terms of corporate finance and net present value. What's the net present value of every project I take if I earn exactly my cost of capital? 0. What happens to your value if you take one project with a net present value of 0? Nothing. What if you take 100 projects with a net present value of 0? 0. Once your return on capital is equal to your cost of capital, it doesn't matter what your growth rate is. It doesn't add value, it doesn't take away from value. That is why when your return on capital is equal to the cost of capital, you might as well use a 0 growth rate. It doesn't matter anymore. It is true that if you can earn more than your cost of capital in perpetuity, which must mean you're in a business where there are competitive barriers that are really long-term, like CocaCola, like Microsoft, then increasing my growth rate increases my terminal value. Because there, the new projects bring in positive net present value. But I also mentioned, I think, during the last class that about 60% of global companies earn less than their cost of capital. If you're a company earning less than your cost of capital and you try to grow, guess what happens every time you try for more growth? Every time you try to grow faster, my value decreases. You're taking negative net present value projects. It's not the growth rate assumption that drives terminal value. It's what you assume about returns on capital in perpetuity that are reflected in your terminal value. Which means when you tell your story about your company, you got to think about the end game in that story. What will your company look like as a mature company? Is this the kind of business where you can earn more than the cost of capital in perpetuity? If the answer is yes, then you can let the return on capital be higher than the cost of capital. Technology companies, pharmaceutical companies. If the answer is no, which is the case in many manufacturing companies, then the growth is not going to matter anymore. So why are you wasting your time trying to figure out whether the terminal growth rate should be 2.3% or 2? It's an incredible waste of time. It's not changing your value. Spend more time on the return on capital assumption in perpetuity and less time on what the growth rate itself should be. In 1988, my book on valuation came out. John Wiley published. And same year, they published a book by McKinsey. Some of you might have seen the McKinsey valuation book. So our books came out at the same time. And the McKinsey valuation book, because actually, I read it, I've read it multiple times. I like the book, but in their terminal value calculation, that book, the terminal value is no PLAT, which is after-tax operating income divided by cost of capital. And for 35 years now, I've got emails from people reading the McKinsey book asking, why in the terminal value do they not have a growth rate? To which my response is, why aren't you writing to McKinsey? Why are you writing to me? But they must think that we are the same publisher. We all hang out in the same place and talk about valuation all the time. And there's a reason for that. McKinsey actually kind of mentions it in passing. McKinsey makes the assumption that if you're a mature company, a stable company, that you can't earn more than your cost of capital. It's an assumption. But the minute you make that assumption, you see why G can disappear from your calculation? Because the previous page, I showed you what happens when your return on capital is equal to the cost of capital. It doesn't matter what your growth rate is, so you might as well use a 0% growth rate. I think it's a little too rigid to take a CocaCola or a Facebook or a Microsoft and make the return on capital equal to the cost of capital. But that's a McKinsey assumption. But McKinsey in its own research kind of undercuts that assumption. Let me explain what I mean by that. McKinsey actually is, there's a publication from McKinsey called McKinsey Quarterly. If you get a chance, get on the McKinsey website, you can sign up for it, it's free. It's a great publication to read. And what they use is the data that they've collected from their own clients to answer many big questions in corporate finance valuation. So in their studies, they show that over time, as companies get bigger, the revenue growth rate decreases, which makes sense because we do make companies bigger, they make them mature companies. But as companies stay on, their return on capital doesn't drop to the cost of capital. So even in their own research, there's findings that at least for a subset of companies, the returns on capital stay above the cost of capital. So I prefer my approach where if your return on capital is equal to the cost of capital, the growth doesn't matter. But if it isn't, the growth will continue to matter. Which brings me to one of the most common mistakes I see in terminal value calculations. A lot of analysts, when they try to value companies, will say, look, my company will grow at the inflation rate after year 10. And because it's growing at the inflation rate, they don't need any extra capacity. Because they don't need any extra capacity, I'm going to assume net capex is zero. I don't have to invest in capacity. And working capital needs are minimal. Basically, they're assuming reinvestment of zero and a growth rate of 1% a year, 1.5% a year forever. Don't fall for that ploy. And here's why. If inflation is helping you on your revenues and your earnings, remember, you got to replace the equipment in your capacity every 10, 15 years. That same inflation is going to mean it's more costly now to replace the equipment. There's no escape hatch here. The only conditions under which you can assume no reinvestment is we're willing to assume no growth. The minute you assume growth, then I'm going to push you on how much are you reinvesting to sustain that growth, because you cannot have growth without reinvestment. So last page, and I'll leave you with this. So you get to year 10, you make your company a mature company. Give it the characteristics of a mature company. Your reinvestment rate is going to reflect that. Your return on capital is going to move towards your cost of capital. But here's the number that I want you to think about. Let's say your company started as a young growth company like Airbnb. I gave it a high cost of capital. Why? It's a risky company. You get to year 10, you make it a mature company. Guess what should happen to its cost of capital? It should move towards the cost of capital of a mature company. Don't fall into the trap of keeping your cost of capital fixed while making the rest of your company start to make it look like a mature company. Because then it's not fair to the company to give it the growth rate of a mature company, but leave it with the cost of capital of a risky company. So take a look at the email I will send you. There are these 5 blog posts I wrote a long time ago on terminal value that kind of capture what I said about terminal value. This is where discounted cash flow valuations often go wrong. So I want you to read those posts when you get a chance, okay? Because they talk about everything we talked about in class today, perhaps in more detail. See you then.